Hi friends, welcome to Adda 24/7. We are in a Sankalpa series for BFM and today we'll be covering module C and D objective questions. Treasury, very important one. See here, up till now we have covered module A, module B. Now we are covering module C. Okay, so we'll be covering it regularly. Generally we change it regularly so that the entire portion is covered. So that's why watch it at the same time on the same channel every day. Okay, so let's start without wasting the time. Very difficult ones. Questions are difficult ones. Yesterday I had given you an homework. Okay, how many of you have solved this? This I had given you as a homework. Which of the following? This was yesterday's homework. Yesterday's, I'll write it over here. Yesterday's. Okay, this was yesterday's homework. So what was it? Which of the following statements is correct regarding the yield curve risk? Yield curve. Okay. A bank needs to evaluate the movement in yield curves and impact on the curve on the portfolio value and the income. So bank needs to evaluate the movement in the yield curves. What do you mean by yield curve first? Yield curve means what is the yield I am getting? What do you mean by yield I am getting? What is meant by yield? Yield means returns versus my investment. Keep it very simple. Returns versus my investment. So when I plot this various yields for various maturities, these are time, this is time. For various maturities, when I plot, I get this curve, and this curve is known as yield curve. Okay. So let's say for a bond, okay, bond of let's say AAA rating of various maturities, 3 months to 10 years. Suppose if I plot these bonds and the yield of these bonds, okay. So this will give me this is yield over here, yield. This on y-axis it is yield and on x-axis it is time. So if I go on plotting the yields of various bonds from 3 months to 10 years of the same rating, this is very important. Then the curve which I get is known as the yield curve. So what is this yield curve risk? If it goes down, then what? If it goes up, then what? If it goes curved, then what? So a bank needs to evaluate the movement in the yield curves and impact on the curve of the curve on the portfolio and the income. So obviously bank needs to check this, okay, because as the yield curve changes, so the bank's income and earning also changes, profit and loss also changes. If the liability is raised through 364-day T-bill and is used to fund an asset of 91-day T-bills, it will lead to yield curve risk. So liability is raised. Liability means I'm raising a liability means what? Basically, and used to fund an asset means I'm funding an asset. If I take a deposit of let's say 364 days and give a loan of 91 days, then will I be facing a yield curve risk? I may be, because once this 91 days loans matures, again I need to refresh this loan. Again I need to give it to someone else. So will I be able to give it at the same rate? Because this liability is fixed at 364 days, because the rate of interest is fixed for the liability, but this is changing. So I'll be definitely faced with the yield curve risk. So answer is C, both A and B. This was yesterday's homework. Let's start with today's part. The features of net interest position of the risk curve. Net interest position. What are the features of this? When there are more earning assets than paying liabilities, the interest rate may arise. Interest rate may arise if the market interest rate adjusts downwards. Again, means interest rate risk, I feel, yeah. Interest rate risk may arise if the market interest rate moves downwards. Now, what is this? When there are more earnings than this, so assets are more than liabilities, okay? Then what happens if the interest rate risk may arise if the market interest rate goes down, moves down. So if there are more assets than liabilities, what does it mean? I'm having more earning, right? My income is more because assets are more. So in that case, if the interest rate goes down, what happens? My earning will reduce. My surplus earning will reduce. So that's why I may be faced with the interest rate risk. So answer is A, correct. What about B? It may result in reduction of net interest income. So that is also true. It may result in reduction of NII. Right? What is the difference between NII and NIM? NII means what? Net interest income. Okay, and NIM. What is the difference between these two? NIM equals to NII upon earning assets, you call it. Actually, you can write it assets also, but it's actually earning assets, not NPA ones. Okay. So this is NIM, and NII means net interest income, difference between your liabilities and asset products. Okay. That interest earning. It will have impact on the economic value of the bank's assets, right? So that is also true. So C is also true. So the answer is D, all of them, isn't it? How many of you got this correct? Type in the comment section. If you got this here, be true to yourself, because in exam I won't be there. It's you who will be answering it. So be true to yourself. How many of you got this correct? D1. Type yes. Correct. Got it? So D. Which of the following are not the features of the price risk? Not the features. And price risk. Price means what? Price of the bond goes up or down. That is basically the meaning. So here, always remember one thing. Interest rate, I'll call it rate. Okay. Interest rate risk is always related to price risk. Both of them go hand in hand. Price risk. Okay. Because the logic over here is, if the interest rate goes up, repo rate, let's say, if the repo rate goes up, the price of the bond will go down. Price of the bond, okay, it always goes down. So it will go down. So that's why they go hand in hand. Interest up, price down. Interest down, price up. So which of the following is not the feature of the price risk? When the assets are sold after their maturity, it may result in price risk. So assets are sold after their maturities, okay. So it may result in price risk. Is it so? When assets are being sold after their maturities, okay, I'm holding those maturities with me. So it may result in price, means the price may go up or down. Is it so? It will never, because after the maturity means what? Whatever is the final amount, I've got it over there. Now, when do I take it? That's a separate aspect altogether. Up to the maturity, only the price risk is there. This is known as operations risk. This is the part of operations risk. If you hold the bonds after the maturity also, means your operation team is not working properly. So this is when the assets are sold after the maturity, it may result in price risk. So not a feature. So this is, we want false one, and this is false one. Okay, so this is true. What about the second one? The price risk is closely associated with banks' trading volume. Price risk is associated with banks' trading volume. That is true, but okay, because the more the trading volume, more will I have the price risk. Banks may create such trading investments out of short-term movements in the interest rates. So that is also true. I can create investments by the short-term movement. So this is true, but I want what? False. So only A is the answer. When assets are sold after the maturity, it may result in the price risk. Okay, I'll clear this board over here. Okay, so that you can watch it freely. So this answer is A over here. Okay. Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests. Whatever we require for clearing JIB and CIB, we get it over here. What do you require for JIB and CIB clearing? 3 things only. Only 3 things. One is ebooks, means books basically. Second is test to check your knowledge. And third is classes. So all of them are over here. Okay, download it right now. Which of the following statements are not correct? Here, always focus on the question. Do they want correct or not correct, true or false, whatever. Okay. So this is, they want false. Okay. Now focus on false. The bond prices and the yields are directly related. Directly. I just now told you in that second question only, right? That bond prices and yields are inversely related. Okay, so this is false. So you have got the answer. Is there any answer? All of the above over here? No. So others are not true at all. Move this, take this and move on. But let's see the other one, because now we are in the study session. In the exam, don't waste your time. Immediately move on. Okay. Market risk may apply for pricing risk for the assets held in the trading book. So market risk may apply for pricing risk for the assets held in the trading book. So that is true. There are two books in the banking. Always remember, trading and second book is what? Banking book. Here the assets or the bonds are held over here for up to the maturity. This is for statutory purposes, CRR, SLR, and this is for proprietary, means buying and selling, earning profit. So that is true. So that's why this is not the answer. We want a false one. The market risk may also apply in foreign currency risk. So obviously, market risk means what? Which is not in your hands. What is the meaning of market risk? That risk which is not in your hands, right? Like Russia-Ukraine war, COVID, is it in your hands? Nothing. RBI changing the repo rates, it's not in your hands. So that's why market risk may also apply to foreign currency risk. So that is also true. So the answer is only A. Okay, clear, everyone? Everyone type yes in the comment section if you have understood up till now. Type yes in the comment section if you have understood up till now. Type yes, everyone. Let me see the comments. Yeah. Fast. Got it? Clear? Concepts are clear? Move on. Will you be able to answer in the exam? If it is asked, will you be able to answer it in the exam? Without remembering. So don't mug up. You need to understand this. Because mugging up is not possible in BFM at all. Not at all possible. Because the subject is so huge. And there are so many possibilities, so many numericals, so many case studies over here. Variety of questions are there. That's why I would suggest join this Sankalpa batch. Okay, I'll come to this later. I'll show you how to join it. We are covering all the numericals, objective questions, case studies, everything is covered. Okay. What is not a forex risk here? That's why they ask you these negative questions. Not. So we want not. False again. False. A risk may arise due to favorable exchange rate movements in the forex. It's called as forex risk. Favorable means I buy dollar for, let's say, 75 rupees. Okay. And now the dollar rate is 85 rupees. So is this a risk to me? I have brought it. See, I have purchased it. I have bought it at this rate. And now the rate is 85. Is it good for me? It is good for me, isn't it? So this is not a risk. This is false. And this is what I want. See, first only you got this answer A. But what about this? Now there is the option of all of these also. So these and these can also be false. This forex risk occurs on account of open position in spot or forward contracts. So this forex risk arises because of open position in the spot. Open position means what? Day end position. Right? Open cash or day end cash. Volt cash, what we say. In our bank we have volt cash. Same logic. Volt position. Day end position. So this will definitely arise because of this. So this is true. So obviously now don't even check this third answer, right? In exam, don't check it because you know this is true. So all of them can't be the answer. So A is the answer. Now for just checking this, as we are in the study mode, that's why it is applicable to individual foreign currency. That is also true. Individual foreign currency means same logic. I brought dollar at 75 rupees and now it is 70. Then it is applicable, right? So this is true, right? Everyone subscribe to Officers Adda 24/7 YouTube channel. Here, in this channel, you will be getting the free YouTube series. Okay. Plus, we are having Instagram channels. It's a few free YouTube series on all the subjects. We are having Instagram channels, LinkedIn channels. Join them ASAP. Okay. I'll show you how to join them. These features of the these are the features of the basis risk. Basis risk means what? What is meant by basis risk? The rate of interest of liabilities and assets, means deposits and this loans, changes differently in different magnitudes. ROI changes differently, means the rate of interest of deposit changes by 2% and rate of interest of loan changes by only 1%. So that is known as the basis risk. When the interest rates of different assets, liabilities and off-balance sheet items change in different magnitudes, it is called as basis risk. What is it? Now you tell me. Is A true? A correct answer? Yes? Type yes if you feel A is the correct answer. Interest rates of different assets, liabilities and all these. Okay? So A is correct. Okay? But there is the option called as all of these. So that we'll have to check now. All of these means I'll have to check B and C also. When the interest rate of assets rises in different magnitudes as compared to the interest rate in the corresponding liability, which may result in variation in net interest income, it would be known as basis risk. So again the same, wording is different only, logic is same. Assets interest rate rises with in different magnitude than that of the liability. That's it. So B is also true. So once you get A and B true, immediately you jump to D. Okay, because obviously C will be true, isn't it? So the basis risk is quite visible in volatile interest rate scenario. Obviously, volatile means high changing interest rates, very high changing. Okay. Right now in US, the same thing is happening. If you check USA, they are facing the same crisis now, volatile interest rates. Okay. Which of the following is not correct regarding the basis risk? Not. So again, we want what? False. Always immediately mark this. You want false answer. When the variation in the market interest rate affects net interest income, income to expand it, it will be unfavorable basis shift. So variation in the interest rate affects the net interest income to expand it. It will have unfavorable. So net interest income is expanded. So it will have unfavorable. Expanded means what? My net interest income is increased. So if it is increased, then is it unfavorable for me? So that is false, obviously, isn't it? So this is gone. So A is the only answer. Don't even look at B and C because all of these is not the option. So A is the only answer. But then also, today we'll do it. In exam, don't do it. Exam, just move on. Okay. When the interest rate movement causes net interest income to contract, the basis would be moved against the bank. So obviously, net interest income to contract. Contract means it is against me, in unfavorable to me, isn't it? So that's why B is true. So this is not the answer. We want false. This is true. Okay? True. The loan portfolio is funded out of a composite liability portfolio. This causes higher degree of basis risk. See here, composite liability. Composite means various liabilities. Liabilities can be saving, can be current, can be FD. So if I am having the composite liabilities, this will cause a higher degree of risk to me. Obviously, because all will change in different magnitudes. So that is true. We want a false one. Okay. Now I told you how to join this Officers Adda 24/7 YouTube channel. See here. On LinkedIn, this is for LinkedIn. Okay, LinkedIn. No, sorry, not LinkedIn. That's this Telegram channel. LinkedIn I generally use. Okay, Telegram channel. So this blue one is for Telegram channel. This black one is for your YouTube YT. Okay, and this next one is for Instagram. So join all of these. Insta. Okay, join all of these. Scan this. Just scan this and you'll get it. Okay. Because as I told you, we cover all the important YT series, all the important questions, important tests on these channels. Immediately join it. Okay. The features of embedded option risk are, embedded option means what? What is embedded option risk? It means anyone can repay my loan. Suppose if I have given a loan to somebody, term loan or CC. Customer comes tomorrow with all the money and says, okay, tata bye bye, take your loan back. Deposit. Customer comes tomorrow with the slip, the deposit slip or that deposit receipt and tells me, tata bye bye, take this receipt, give me my money. So this is embedded option risk, where the customer can withdraw their deposit funds anytime or repay their loans anytime. So which are the features of embedded option risk? When the bank is exposed to the risk due to prepayment. See here, prepayment of loan or premature withdrawal of term deposit. It is called as embedded option risk. Just now I told you, same, right? So A is the answer, but there is an option of all of these also. Check this now. This can be experienced in volatile situations. Volatile means too much changing rate of interest. This generally happens in volatile. Okay, so B is also the answer. So obviously now D will be the answer. C is true. The greater the magnitude of the changes in the interest rate, the higher will be the embedded option risk. So more the changes in the interest rates, more will be the embedded option risk. So that is correct. Okay. These things do happen in volatile situations, because what happens if the customer is having a loan with you Okay. And now due to volatility, the rate of interest of the loan changes drastically. Right now you are giving the loan at, let's say, 8% to this customer. Okay. And due to the volatile situation, your bank increases the rate to 10%. So good customers will run away from you. Run away. They won't stay with you. Okay. Why? Because 8 to 10, whose 2% extra is a huge amount for larger loans. Okay. So this is embedded option. Which of the following is not correct regarding the embedded option? We want a false one now. Okay. This results in reduction of the projected cash flow. So not correct, embedded option, reduction in the projected cash flow. Yeah, that is true. Okay. So we want a false one. Huh? It does not affect the bank's income. What is this? Does not affect. It is false. It does affect. So B is the right answer. Don't even look at C and D now, because there is no option of all of these. If you want, I'll just go through it. Here, the risk may arise due to premature exercise of call put option. So that is true. What is call put option? Call put means the customer has a right to repay the loan or withdraw the cash. Okay, that is call put option. And D1, the withdrawal of deposit before maturity date would also cause embedded option risk before maturity, isn't it? Just now we saw that. So that is also true. So that's why I said in exam, don't even look at C and D. Immediately move on. Okay. Now one for your homework. A counterparty risk is what? What is a counterparty risk? Study that. I have taken this earlier, but then also study it again. It arises due to non-performance of the trading partners where the counterparty may refuse to perform. It is treated as a transient financial risk. It is more associated with trading and all of these. It's your call now. You have to give me the answer. Type in the comment section if you know it, or tomorrow I'll tell you the answer. Okay. We are in the BFM Sankalpa series, and in this series we are covering important theory and objective questions. And today's topic is technology in international banking. Here, the same topic is going on in the paid class also. Everyone, kindly note. Same topic is going on in the paid class. So, if those who are in the paid class, they can follow this series also for the important definitions. Okay. So you guys, those who are watching on YouTube, kindly join the paid classes, because in details it is covered. It is covered over there. Okay. So let's start. Here, we'll be doing today the important definitions which are asked in the exam. Very important definitions. Okay. Because these definitions I have seen it in so many exams. Okay. So fintech. First definition. Fintech means what? Fintech refers to the synergy between the finance and the technology. See here, sometimes they call it fintech, and there is a separate word called as techfin also. Techfin. Okay. So techfin and fintech, these are not same words. Fintech means first finance, and then technology. Finance plus technology. So basically this company is in finance and then it is using technology. But techfin over here means the company is in technology. Understand the difference? Technology, and then it is doing finance. Okay. Now you'll say, sir, what is the difference? Only words are the different over here. See, the difference is like this. Suppose SBI will fall in fintech. SBI, HDFC Bank, all are banks. They are fintech. They are first finance, then technology. Techfin means what? Google will fall in techfin because it is first technology and then it is giving loans. PhonePe, first it is technology, then it is giving loans. Google, PhonePe. Okay. So these are all the techfin companies. Understand the difference? There is a slight difference in the words, but huge difference in the overall companies. Okay. So finance plus technology. Fintech refers to synergy between finance and technology. Okay. Second one, RegTech. Now what is this RegTech? See here the words, you can break it up over here. Reg means regulatory. Reg plus tech. So reg refers to regulatory. Technology in regulatory aspects, focusing on automation of the compliance processes for the banks. Right. So automation of the compliance What do you mean by automation of the compliance? What is this? Okay. See here, I'll give you simple reason, simple logic behind this. Compliance. Let's talk of simple terms like large cash transaction report. Okay. Large cash transaction report means any transaction about 10 lakhs of cash, right? So in large cash transaction report, why has a bank or the employee to report it? As you are having the technology over here, right? So immediately it should be reported, it should catch which is the large cash transaction report and give it, isn't it? So that is known as automation. Similarly for this bill of entry also in trade finance. Now those who have covered this batch, those who are in the batch, they'll understand the SDF form and BF form. BEF. I told you BEF entry is now BEF report is now removed, right? Why? Because of this automation in the technology. Means bill of entry, whatever is coming in, why should it be reported separately now? Once it's in the customs office, you get it through their system, it is automatically reported to RBI, isn't it? So automation means reducing or removing the manual work in the compliance part at least. Okay, because compliance, always the problem in compliance is if there is a human intervention, always it faces the problem. There is some error, some manual error. So if it is done by machinery, nothing as such. What has happened in clearing now, isn't it? What is clearing? Clearing is gone now. It's all automation now, isn't it? AI, artificial intelligence. It refers to the simulation of human intelligence in machines that are programmed to think like human beings and mimic their actions. Understand this, programmed to think like human beings. You'll say, sir, how can a machine replace a human being? Of course it can't. No machine can replace a human being. But if you look at your banking activities, what are you doing in the banking? Tell me. If you look at the banking activities, just tell me one answer. Everyone give me the answer in the comment section. Give me one answer. How much part of your job is repetitive in nature? Repetitive means daily you are doing the same job. Same job, same desk, everything. So how much part of your job is repetitive? I'll give you two options. One is almost 90% of your job, and second is 10% of your job is repetitive. Every time it's a new job. Right? Give it in the comment section. Everyone write in the comment section. How much part of your job is repetitive? Correct. Almost 90% of your job is repetitive. 90%. Because daily you can't have new things, isn't it? Will you have daily new challenges? No. We'll have repetitive job almost every day. Some days some new thing comes. Okay, so whatever is repetitive, that can be done by the AI. Here, simple thing is, whatever is repetitive can be handled by the machines. It's that simple. Okay, and mimic their actions. Mimic means rehearse, means do it again. Okay. So AI basically, whatever you are seeing right now, chatbots. What are chatbots? Chatbots we see everywhere nowadays. You go to any site and you see, may I help you? Then you type in that message and then you get chatbots. So now chatbots have gone to the higher level. Now we have something called as chat GPT. So chat GPT, what do you get over there in chat GPT? You get various other things also. Not only this replies, but also you get the artificial intelligence helps you to find the answers to the repetitive questions of the customers. Okay. Next is machine learning. Machine learning refers to the usage of algorithm by analyzing millions of data sets to provide inputs to the banks in the areas of customer transaction history, behavioral pattern, advisory services, etc., thereby enhancing the customer experiences with the banks. Now, what do you mean by machine learning? Here, machine learning is known as learning by the machine. It refers to the algorithm by analyzing millions of data sets to provide inputs to the banks. So, learning by the machine means this is called as, there's a word in machine learning that is called as cognitive. This word you will hear many times. Okay, cognitive, TIVE. Okay, cognitive means continuous learning. It refers to the usage of algorithm by analyzing millions of data sets to provide inputs to the banks in the areas of customer transaction history. So whatever are the customer transactions, whatever are the behavioral patterns of that customer, advisory services. So all these things, basically behavior patterns here. If you see the behavior pattern of any customer in the, at least in the financial field, by that you can definitely govern which products are to be sold correctly to that customer. Okay, thereby enhancing the customer's experience with the banks. So if the customer receives proper treatment or proper advice as per the customer's requirement, then definitely what happens? In that case, the customer will stick more to your bank rather than giving some vague. Means, for example, I'll give you. Suppose if any customer is requiring, let's say, loan. Okay, he is facing some financial problem, and you are trying to pitch to that customer insurance or mutual fund. These are investment products. So will that customer come for this mutual fund or investment with you? No. That customer requires a loan, so you have to pitch in the loans. How will you know whether that customer requires a loan or not? Through his or her behavior pattern. Okay. Behavior pattern means if that customer has asked for the loans, or if there is huge cash withdrawal or transfers from that account. So that is all captured under AI now and machine learning. Okay. So it refers to the usage of algorithm. Remember this word algorithm. What is algorithm? Algorithm is a set of computer programs. Okay, done. Computer programs. Okay, which make this machine think on the repetitive jobs. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting latest updates on JIB and CAIIB. Number one. Number two, you will be getting all the free YouTube series on JIB and CAIIB. So subscribe to it, click on the bell icon, click on the like button, click on the share button, share it with your friends, isn't it? What is big data and data analytics? See here. Big data deals with the data sets that are too large or complex to be dealt with the traditional data processing application software. Now, what do you mean by this? See here. Many times in your computer itself, we see our own computer, your home PC it might be, or in your bank PC also. The computer operator or the admin guy, systems administration, when that person checks your computer and he or she says, your data is too much loaded, your server or your CPU does not support it, your laptop doesn't support it, memory is too much gone. What is that? What is that person saying actually? That person is talking of big data. See here, every machine has its own capacity. Again, suppose if I want a huge data analysis of entire banking industry, I can't keep it on a single PC or even a simple server. For that, huge servers are required, right? So big data deals with data sets that are too large or complex to be dealt with by traditional data processing application software. Okay. Big data is advantageous where volume, variety, and velocity of the data is huge. Now understand the three words, very important. Okay, volume, variety, and velocity. Velocity means speed. We require huge speed. Okay, science graduates might understand this. Okay, velocity is speed. So volume, variety, and speed. All the three things are required and they are huge. Volume is huge means if you consider SBI, what will be the volume? If you consider your own bank, forget SBI, your own bank, what will be the volume? Per day volume. It will be huge. So your server needs to cope up with such big volume. Variety. There are thousands of transactions, variety of transactions. So all the variety needs to be captured in your system. Similarly, velocity, speed. If you imagine in the bank, if when you are using your system and if it takes around 1 minute to answer, even 1 minute is a long time in front of that customer. Waiting for 1 minute is a huge time. Okay, so that's why it needs to be at a huge speed. That's why we have all these 4G, 5G, 6G, all these things. Okay, got it? Data privacy and digital privacy. Now, what is this data privacy? See this. These words many of you might be knowing now by now, isn't it? Privacy means secrecy, right? Digital privacy, same. Okay, digital and data both mean one and the same thing. So data privacy or digital privacy refers to the protection of an individual's information that is used or created while using the internet on the computer or a personal device. So what do you mean by this? Refers to the protection of individuals' information. Individuals' information. Okay. Now what all information can the individual have? Individual will be having various informations like name, mobile number, that is common thing, address, right? But like graduate, what is your education level? Then what is your family size? Are you holding any assets, car or anything? Okay. Plus, have you taken any loans? So these are all the individual information. Remember, individual information can be of two types. Always remember, it will be of two types. One is static, and second is dynamic. Okay, dynamic. Static means what? Which does not change. Means what? Your name, generally your name, your address, or your Aadhaar number. These don't change. PAN number, they don't change at all. What is dynamic? Are you holding a car? Are you holding some loans? These are all dynamic things, right? Education level is static generally, because once you are educated, you won't change your education. Yeah, generally I'm talking, huh? Somebody can do the changes in that also, okay? So static and dynamic means that, okay? Refers to the protection of individuals' information that is used or created while using the internet. While using the internet means whenever I fill up any form for Google, or if I fill up any form for your bank, online form. So if that form, it gives my all the details and that is breached, that is shared by your bank, let's say, with someone else. So what is that? That is affecting my privacy, isn't it? While using the internet on a computer or a personal device. Personal device means anything related to computer or mobile also. Okay. Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests, whatever we require for clearing the JIB and CIB, we'll be getting it over here. So that's why download it right now. Okay. Data breach. What is data breach? Sure. Just now we talked about data privacy. Importantly, remember, these are all the important questions. And you'll get some of them, at least 2 or 3 of them, 2 at least out of this series, whatever we are talking right now. Today's session, you'll get at least 2 1-mark questions in your exam. Okay. So now you know, everyone among in CIB knows the difference between 1 mark, the importance of 1 mark. The difference is 49 and 50, right? 49, 50 is cleared and 49 is not cleared, isn't it? So data breach. Data breach refers to the security incident in which malicious insider or external attackers gain unauthorized access to the confidential data or the sensitive information, such as medical records, financial information, or personally identifiable information. Now, data breach means what? Just now we discussed about this, static and dynamic, right? Dynamic means what here? This security, generally this dynamic information is very sensitive, because static information generally everyone knows. Where are you staying? What are you doing? Okay, all these things which don't change. This generally everyone knows. What is important is dynamic, and all the companies want this dynamic data, because it is changing. It is changing, and what happens? Your habits are changing accordingly. So data breach refers to security incident in which the malicious insider. What do you mean by malicious insider? Insider means that person working in the bank itself. That person compromises the data and gives it to some other external company or external attackers. External attackers means what? These are all those attackers, these cyber attacks. Okay. So these cyber attackers or these insiders gain unauthorized access. Unauthorized means even the banker can get unauthorized access. Suppose if you are in the branch, do you have the access to the head office data or sensitive data, balance sheet and everything? Do you have access to that? No. That is, if you have access, you are in the branch, you have to get access only to your part. So that is known as unauthorized data. If you get information about something else which is not required by you, so that is known as unauthorized data. Okay. So unauthorized access to the confidential data or the sensitive information such as medical reports, financial information, or personally identifiable information. So medical reports, sure, that's what I said. These all things are dynamic. If you check this, these are all dynamic, right? Dynamic means what? They go on changing. Dynamic, right? Medical reports, they go on changing. Financial information changes. Personally identifiable information, right? So these are all the changing things. Okay. So mainly the access to this is required by the companies so that they can sell the various products to you. Okay. P2P lending means a financial innovation which connects borrowers seeking secured and unsecured personal loans with investors looking to earn higher returns on their investments. P2B. P2B means peer to peer. This is known as peer to peer, or in simple you can call it peer to. It's two, peer. In simple way, peer. You can call it peer, people to people. P2P lending is an important aspect coming. This P2P lending will change the entire banking scenario. Remember this. So, financial innovation which connects borrowers seeking secured and unsecured personal loans with investors looking to earn higher returns on their investments. So, P2P lending will change the entire. See, right now, what is happening? Why are people depositing money in the banks? Because they don't know who is to take, who wants the loan, and they don't have the confidence on that person who will get the loan, right? Suppose if I get somebody, tomorrow you require the loan. Okay, you require, let's say, 1 lakh rupees, and I'm having excess 1 lakh rupees. So why should I deposit it in the bank and then that bank gives you the loan? I'll directly give you. So that is known as P2P lending. So there are certain problems in that, but those can be tackled nowadays. There is account aggregator system that can definitely tackle it. So it means secured and unsecured personal loan, the person who wants it with the investor, connecting this buyer and seller. It's that simple. Cloud computing, it refers to the delivery of computing services including servers, storage, databases, networking, software, analytics, and intelligence over the internet to offer faster innovation, flexible resources, and economies of scale. Cloud computing, you must definitely know this definition because this is the important part of technology in international banking. Computing services including servers, blah blah blah, storages, databases, software, analytics over the internet. Now remember, over the internet means this is the server will not be a physical server, it will be in the cloud. You might have seen many of these, right? Many of the companies have come like that. What GoDaddy, right? There's a company called as GoDaddy. Check that, okay? That is giving online servers. Okay, there is many of them are there. One I know because I've used that data. Servers, storage, databases, networking, software, analytics, everything on the internet. There is no physical existence. To offer faster innovation, flexible resources, and economies of scale, right? Clear? So everything is on internet over here. There is no physical thing. Okay. Now, to join, as I told you, join this Adda 24/7 app, download this app, or join the YouTube channel. But how to join it? See, just scan this QR code right now. This blue QR code is for Telegram channel, official Telegram channel. Scan it. For all, you might be in JIB, you might be in CAIIB or any other bank promotion. Similarly, YouTube. Scan this right side QR code, this one, okay? This QR code. Then if you want to join this Instagram, okay, join this QR, Instagram. Okay, scan this QR code and you'll join this Instagram channel. Remember, there are many fake channels available. Fake channels. So we need not join those. Okay? Because here in the world there are always copycats, right? So that's why join it immediately. DigiBank, an entire bank squeezed to fit in your smartphone. DigiBank, there is no physical existence of that bank. Remember, there is no physical existence of that bank. There is only one head office and there are no branches. DBS has started DBS. They have started DigiBank. Many of the Indian banks have also started DigiBank. No physical branch, only head office. That's it. Regulatory sandbox. This is a new definition. It refers to an environment where it allows the regulator, the innovators, and the financial service providers and the customers as final users to conduct field tests to collect evidence on the benefits and risk of the new financial products. So, where regulator, innovator, and the financial service providers. Now, look at this. All these elements, these are all the we call the stakeholders: regulator, innovator, financial service provider, customers as the final user to conduct field test to collect evidence. So field test is collected. Important part over here is field test. Okay, conduct field test to collect evidence on the benefits and risks of the new financial product. So whenever I am launching a new product, what are the benefits of that? Will it be harmful? Will it suffice my this purpose? So that all evidence is collected using this regulatory sandbox. Okay, understand this word is very important. Conduct field test to collect evidence on the benefits and risk of the new financial products. Robotic process automation. It refers to the process of assigning manual repetitive tasks to robotics instead of humans in order to streamline workflows in financial institutions. So it refers to what? The process of assigning manual repetitive tasks to the robotics. Here, assigning manual repetitive tasks to the robotics instead of human beings. So robotics instead of human being, that is the basic logic behind this robotics process automation. So human beings should not be used for repetitive jobs. Human beings should be used for innovative jobs. Okay. Blockchain technology. Blockchain is a system of recording information in a way that makes it difficult or impossible to change, hack, or cheat the system. Okay. So blockchain is basically recording information. Okay. The USD INR rate is 48.10 and pound to USD rate is 1, only 1. What is the rate of pound to INR? Now first tell me, what is this chain rule? Which rule will we use over here? The rule which we'll be using is, here, whenever we want some rate which is not given, is pound to INR rate given? What is pound? Pound means we call it GBP. GBP. I don't call it GBP. Great Britain pound. Is there anything great about Great Britain now? We are bigger economy than that Britain now, UK, right? India is a bigger economy than UK. Then what's great about it? I'll just call it pound. Okay? Yeah. So USD to INR rate is 48.10 and pound to USD rate is 1. What is the rate for this pound to INR rate? Now the question over here is, we'll be using the which rule? Type in the comment section. It is called as chain rule. Chain, correct? What is the chain rule? Chain rule is pound, it's written as like this, pound to INR we want it, rupee, right? So pound, you had this in JIB, no? How many of you remember? You had this in JIB. Type yes in the comment section if you remember this. Yeah, it is. Pound to dollar will bring in a common currency over here. Pound to dollar. See here, we want pound to rupee. So pound to dollar into dollar to rupee, right? In the comment section, everyone, type the answer now. See this, pound to dollar. Do we have pound to dollar? See this, pound to USD given 1. So it is 1 into dollar to rupees. What is the dollar to rupees rate given? 48.10. 48.10. So what is the answer? Same, 48.10. See this, D. Isn't it? D is the answer. Right? So this is called as chain rule. Always remember, while solving any Forex, the important part which is remains in CAIIB is, after you get this rate, you have to either add or subtract the margin. Add or subtract depending on the transaction. Add or subtract the margin. Which exchange margin? Remember, this is up in JIB you had the problem up to this much only. In CAIIB you have the exchange margin also. So this exchange margin, you have to either add or subtract it. Now, how will you decide whether to add or subtract? You will decide it based on the basis of, suppose if you are selling, suppose if you are doing sale means what? When will you sell? You will sell it in import transaction. Suppose if you are doing the import transaction or sale, right, then you will be adding the exchange margin, add. Okay, it's not asked in this problem, but in exam they'll definitely ask you. They'll ask you some margin like TT margin is, let's say they'll ask you 0.15%. Now find the rate. TT margin is 0.15%. So what will you do? This rate which you get, now you'll first find out the TT margin, 48.10 into 0.15%. This is what you'll have to find it out. Okay. So multiply this. Okay, let me solve this problem only now, right? Because in CAIIB you get higher level problems. These problems you get it. So 48.10. What is the answer you are getting? Into 0.15%. Percent means divided by 100. So it will be 0.0015. So what is the answer you are getting, guys? What is the margin which is what is the margin you are getting in rupees? So 48.10 into 0.0015. See this 0015. Okay. So this answer, type in the comment section. What are you getting it over here? In the comment section, it is 0.072. Now what will you do with this margin? This is your margin in figure. This was in percentage. Now it is in numericals. Okay, number. So what will you do in this problem? So what is it given? USD INR rate is given, pound. What is the rate you will be taking? So it's not given whether it's a buy or sell. So let's assume it's a import transaction. Import. Okay, import. Right. So you'll sell it over here. In exam they'll be giving clearly import or export. So import means sell. So you'll have to add this. So what will be your final rate? It will be 48 point. Add this 48.10 plus 48.072. Add this, everyone. Answer which you will be getting is 48.1. Then what? 172. This is the final answer you will be getting if exchange margin is given. If not given, then 48.10. That's simple. Okay. Clear, everyone? Type yes in the comment section if you have understood it. Type yes in the comment section if you have understood it. Okay. Chalo, next one. USD INR rate is 48.10 and JPY USD JPY rate is this much. It is point over here, 91.50. What is the rate of INR to JPY? Now again, see here. What are you doing? You are again using the chain rule. Calculate the rate for 100 JPY. Say this 100 JPY means always JPY is calculated in terms of hundreds only. We never get the rate for 1 JPY and then keep it as it is because it's very small. But for getting this 100 JPY, we need to get first 1 JPY rate. So again use the chain rule. We want INR to JPY. Look at this, INR to JPY. Here JPY is below, right? So INR to JPY. So what is my INR to JPY? Rupee to JPY, right? JPY. Yen is written as like this. Yen and 2 lines. Okay. Rupee to JPY equals to. So you'll get it what? Rupee to. I think so. It should be JPY to INR. Okay. Because we never get this. India never follows this indirect rate system. Let me make the change because you should get it JPY to INR. You'll never get it JPY INR to JPY. Okay. Because we never follow the indirect rate system. We follow the direct rate system. What is direct rate system? In direct rate system, rupee is always moving and other currency is constant. So India follows that system. Okay. So JPY to INR it will be, I'll write it simple. So JPY to INR equals to JPY to rupee, JPY to dollar into INR to, dollar to INR, right? Dollar to INR. So now what all do you have? JPY to dollar do you have? See here, you have USD to JPY, 91.50. So dollar to JPY you are having. Now you want JPY to dollar. So you'll just reverse this. So it is 1 upon 91.50. See this, it's reversed, right? Because it's dollar to JPY and we want JPY to dollar into Dollar to INR, it is 48.10. Now take the answer. Now the answer will be, everyone do it. 48.10 upon 91.50. What is it? What is the answer you're getting? 48.1 upon 91.5, right? 91.5. Oh, did I write 8? 91.5. Okay. So it is 0.5256. 0. I'll write it below. Okay. So 0.5256, right? So this is 1 JPY to INR. 1 JPY to INR. But what is asked over here? They have asked 100. So 100, multiply this by 100. So 100 JPY to INR equals to, multiply this by 100, 52.56. 52.56. So this much is the answer. So 100 JPY equals to 52.56 rupees. Remember, what does this mean? You must understand this first. 100 JPY equals to 52.56 rupees. Okay. So what does it mean? Rupees stronger than JPY. If I ask you, okay, let me ask you this question. 100 JPY equals to 52 INR, let's say. Forget this 0.56. Now tell me, who is stronger? JPY is stronger or rupees stronger? 100 JPY equals to 52 rupees. So who is stronger? Rupee is stronger, correct. Rupee is stronger. In the comment section, rupee is stronger, correct. But remember now, it doesn't mean if any currency is stronger, like rupee is stronger over here, but does it mean India is more developed than Japan? No. We are the 5th largest economy. Japan is almost the 3rd largest economy now. Third or fourth. Germany and Japan, they both are in this fight. We are planning to surpass them in the next 3 years. Both of them. So that's why remember, even though Japan is having the lower currency, then also Japan is a bigger economy than India. Okay. So the answer is what? 52.56. Which is the nearest one? 56. See this one, D. D is the nearest answer. Okay. 52.56. No, 53. Sorry. 52.40. Take this. Okay. In exam, they won't give you such closest answers. Okay. 52.40, 52.80. They'll never give you the answers like this. One will be 52.40, second will be 55 something. Okay. There'll be a huge difference. So you'll be able to immediately identify, because these points hardly make any difference. Okay. So got the answer, everyone? Clear the concept? Shall I move on? Type yes in the comment section if you have understood it, and we shall move on. Okay. Next one. When the exchange rate is fixed by the monetary authority of a country, it is called as by the monetary authority. Remember, monetary authority means RBI. RBI fixes it. Nothing doing. Dollar to rupee rate is today 79, so 79 only. There is no fluctuation, no demand, no supply, nothing. So when the exchange rate is fixed by this monetary authority, it is called as what? Direct, indirect, floating, or fixed? It is fixed rate, correct? It's fixed rate. In where do we have this fixed rate? Do we follow in India this fixed rate system? What do we follow in India? Do we follow fixed rate system, everyone? What do you say? We never follow fixed rate system. We follow floating rate system. Floating means, see, two things you always remember. In India, we always follow, one is direct rate system and second is floating rate system. Direct means rupee is fluctuating, dollar is constant. Okay. And floating means it depends on the demand and supply. Then in which country is this fixed then? Which country says it's fixed? Fixed rate. Fixed rate is hardly in any country now, but then also North Korea, you have this fixed rate system. And there are some minor countries, okay? Even China, I'll tell you, China is also, it's a quasi-fixed. I mean, they are following fake system. I'll tell you, fake. Why? Because they say they are following floating rate system. Floating rate means what? It depends on demand and supply. Demand and supply. Okay. But what happens? The Chinese government interferes heavily in this yuan. Their currency is yuan. Y-U-A-N, yuan. They have two currencies. One is yuan, second is renminbi. We don't hear about this renminbi many times. We hear about yuan. Both are equivalent only. One yuan equals to one renminbi. That's what I'm saying. They are playing the gimmicks over there. We are not going into that geopolitical issue now. But government or the central authority interferes in this and reduces the rate whenever they want, increases the rate whenever they want. They have done this in last 5-6 years. They have done it one night automatically, means one day suddenly the Chinese bank decided that reduce the yuan rate by 7%. Who, why, when, don't know. This is known as fixed rate, means quasi fixed rate. Okay. Some other countries, like I gave you North Korea, there are some other minor one countries are there. Bernudi, no, what is that called as? Some biggest country, oil producer, that is having the fixed rate. Forget it. Important is the government interferes over here. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates from IIBF, for JIB and CAIIB. Whatever IIBF gives, this change, that change, portion change, timing change, venue change, you'll get it over here. Okay. Second thing, you'll get the free YouTube series. Right now, what are you watching? You're watching the same free YouTube series. So you'll be getting all the free YouTube series on all the subjects. So subscribe to it, click on the bell icon, click on the like button, share it with your friends. Okay. Okay. When the exchange rate is fixed by the market demand and supply position, it is called as, just now we discussed, right? Market demand and supply. So it will be called as what? Freely. It is called as indirect. No, sorry. Floating, isn't it? Floating rate. India follows this demand and supply. RBI never interferes in India in this rate. Okay. It never interferes directly. There are two ways of interfering. One is direct here. As a CIB student, you must understand this. Interference, okay, can be done in two ways. One is direct and second is indirect. Okay. Direct means what? Direct means RBI says from today the dollar to INR rate is dollar to rupee rate. Okay, is XYZ. Let's say 85. That's it. Nothing doing, nobody can change it. This is known as fixed. What is indirect? Indirect means what? Here, it depends on demand and supply, but RBI interferes it indirectly. Means what? If the dollar rate is going too high, then RBI will, mean there is a less supply of dollars. So RBI will sell the dollar. So that is allowed. Indirect interference is allowed in all the countries. Even USA we do it, UK it is done, India it is done. Any country, indirect interference is allowed, because that is the job of RBI, right? If your dollar rate goes very high or very low, it immediately affects your inflation position. So that's why indirect interference is clearly allowed. Direct interference is not allowed. Okay. The term bid rate stands for, bid means what? We have this bid offer, right? Bid means what? Your bid, and second is offer. So what is this? Direct, indirect, buying, selling. Always remember, bid is equal to, let me get it from you. Bid is equal to, what is it? Comment section. Let me see in the comment section. Bid stands for, bid means I am bidding. Give me. Aja, yeah. So that is buying rate. Okay, bid equals to buy, and offer means sale, right? Sale. Okay. The selling rate of a foreign currency offered by a bank is called as share. Selling rate of a foreign currency offered by a bank. Offer rate, bid rate, floating rate, fixed rate. Name itself, naam hi kafi hai. Offered. And it is offer rate, right? Sale. You can call it sell rate. Okay. Sell this side. Always on the left side it is buy, and right side it is, left side it is buy, right side it is sell. Okay. Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests. You'll be getting it. Okay. So download it right now and start studying. Country risk is an example of market risk, credit risk, operational risk, and liquidity risk. Country risk, remember. Country risk is an example of Market, credit, operational liquidity. Okay, let me give it to you. Credit. Credit risk is always of two types. Remember this. Okay. One is country and second is counterparty. Counterparty risk. Okay. So country risk means country is in the problem and counterparty means country is good but your party is bad. Okay. Now what does it mean? Country is in the problem means I'll give you example. Afghanistan. Afghanistan. Country is in the problem. Pakistan. Country is in the problem. Right? Sri Lanka. Country is in the problem. Counterparty. USA. Country is good but your party is bad. Not paying you. Okay. So this is the country risk is the part of credit risk. Got it? Credit risk. All of the following types of risk of price risk are price risk except. So all of the following are price risk except commodity price, exchange rate, stock price, counterparty. Just now we saw it, counterparty, isn't it? All these are price, commodity price, price going up and down, exchange rate, price going up or down, stock price, price going up or down, counterparty. Just now we saw it. See this, credit risk. So counterparty is a part of credit risk, right? So this is except, we want except, okay? So that's why this is the answer, except. In the financial market, bond prices and yields are, so prices and yields, bond prices and yields will always be what? Inversely related directly in, this you added in your JIB also. Inversely, directly, inversely or directly depending on the type of the bond. So it is, now this you should get it from your it's a basic knowledge now, okay? So let me see how many of you can answer this. Everyone, yeah? Do it fast. Yeah, it is. Inversely, obviously, isn't it? Inversely. Prices and yields are inversely related always. How to join this here? I've just now told you join this Officers Adda 24/7 YouTube channel, right? How to join this? Scan this QR code, okay? This blue is for Telegram, this black is for YouTube, and this another one is for Instagram. Join it immediately. Why? Because on all these channels, we are giving the free YouTube sessions. Then question banks, you are getting free question banks, questions, free tests. Again, latest updates, various things, various puzzles, various quizzes, you get it for CAIIB and JIB. So scan it right now. Just pause this video, scan it and do it. Okay? Chalo, next one. Rate of cancellation of original export contracts. Here, original export. So export contract is always for what? Just now we told in the first problem, whenever we have export, we have export. Export we have export. Export will always be buy. Right? Buy or bid. Forget it. Keep it simple. Buy. Okay? So if export is at buy, then I have to cancel it. So cancelling will be opposite. What is the opposite of buy? It will be sell. So cancellation will be sell. So firstly I'll use this sell. So forget this buying. So these two are out. Oh, sorry, not these two. Which are out? This is out and this is out. So these two are remaining. TT selling and bill selling. Now which one? TT selling or bill selling? What do you say? Which one is the right answer then? Over here. Cancelling. You are cancelling the rate. Cancelling is always done at TT. Always remember. Booking is done at a bill rate. Okay. So that is the answer. Booking, rate of booking a new import contract for next 1 month. After 1 month. Okay. So it is. Now import. Import means what? Buy or sell. Just now we saw export. Export was buy. So this will be sell. So buy is out. Now TT selling or bill selling. Next 1 month. See here, TT is always used for spot transactions. Right now. I have to cancel the transaction right now. Okay. But next month means 1 month risk you are taking. So whenever you take the risk, it is called as TT selling or bill selling. Bill selling, correct? So that is the answer. Okay. Clear everyone? Got a concept? BFM Sankalpa series, and we are covering various important theory, numericals, objective questions in the same. Today we will be covering the objective questions. Before going ahead, have you seen yesterday's series? Means Saturday and Friday I had completed one series that was numericals. Very important numericals were done. Have you seen that? Type yes if you have not. Kindly follow it again. Go to the channel, follow it again. Important Forex numericals were covered. Very important ones. Huh? So if you have not covered it, if you have not seen it, kindly go and see it because it's very important. You'll get case studies. 2 case studies you'll get on 5 marks, and both the case studies I had covered it over there. Okay. So let's start with the numericals today. Okay. Okay. All done. Everyone set now. So let's start. Chalo. First question. The liquidity risk of the bank arises from. So liquidity risk of the bank, of any bank. Liquidity means what? What do you mean by liquidity risk? It means that I don't have money at right time. That is very important. At right time, whenever I have to pay my EMI, I don't have money. That is a liquidity risk. Same thing about the banks also. Bank has to pay some bond holder. Okay. At that time, bank doesn't have the money. That is liquidity risk. If some depositor comes for withdrawal, bank doesn't have money. That is a liquidity risk. So, this liquidity risk of the bank arises from number one, funding of long-term assets by short-term liabilities. Long-term assets by short-term liabilities. What do you mean by this word? Suppose let's consider all these cases. Okay. Let's consider all these cases. Let's say this is deposits. Here, liabilities means deposits. Assets means loans. Okay. Now, case number A. Funding of long-term assets by short-term liabilities. Means what? I'm having a deposit of 1 year and I'm giving a loan of 3 years. Will this create a liquidity risk for me? Just type yes or no over here. Huh? Let's see later. B1. Funding of short-term assets by long-term liabilities. So deposit of 3 years and loan of 1 year. Will it create a problem for me? Funding of long-term liabilities by short-term assets. C. Funding of long-term liabilities. This is ab initio wrong. This is from start only wrong. Why? Liabilities funded by assets. Is it possible? Not at all possible. Assets are always funded by long-term liabilities. Means long-term or short-term. Assets are funded by the liabilities. So C is ab initio wrong. Okay. Ab initio means from the start itself. We need not even discuss this. That is the point. Now the question lies between A and B. Between A, 1 year deposit I am having and 3 years loan I have given. So will it create a problem for me? Yes, it will create. Why? Because this guy who has deposited, this person will come to me after 1 year, but this person will pay to me after 3 years. So this will be a problem to me. What about B? If this person has given me a deposit of 3 years, this guy will come after 3 years. Isn't it? This guy will come after 3 years, but this guy will pay me immediately after 1 year. So I won't have any liquidity problem over here because whenever this person comes, I can repay him back, him or her. Okay. So the answer is A. Funding of long-term assets by short-term liabilities. This is a basic logic based on which this question is dependent. And such questions are asked to in exam. Remember. Okay. Move on. Funding liquidity risk is defined as funding liquidity. Remember this. Funding means I don't have funds. Liquidity risk, but related to funds. So that is defined as excess of liabilities over assets. Excess of long-term liabilities over long-term assets. Excess of short-term liabilities over short-term assets. Inability to obtain funds to meet the cash flow obligations. Very simple definition. Excess of long-term liabilities over long-term assets. Is this a liquidity risk? Excess of liabilities means more of deposits, less of loans. Obviously, that can be the answer. Similarly, B can also be the answer. Look at this. All the answers seem to be right. All of them. You check this. All of them seem to be right. Liability is greater than assets here. I'll show you over here. Liabilities greater than asset. In all the cases, logic is same. Okay. Liabilities are greater than assets here. Over here, excess liabilities over assets. Here, long-term over long-term. But after all, the same. Liabilities and assets. Short-term over short-term. Logic is same. Liabilities over assets. So, logic is liabilities are more than assets. So, definitely that is the answer. Whenever I have deposits of let's say 100 rupees, okay, and loans of let's say 70 rupees, okay, so will it be a problem for me as a bank? As a bank, do I have a problem in this case? Okay, just check your bank's ratios, your bank's loans and asset deposit ratios. Is it always 100? Let's say this is 100, this is also 100. Is it always 100? No. RBI has given the term as your liabilities and assets should always be 70%. So this is right. Okay, assets will always be lesser than your liabilities. Always. Means basically loans will always be lesser than your deposits. Of course, the ratio is matched so that the rate of interest NII is not affected much. So the correct answer is this: inability to obtain funds to meet the cash flow obligation. That is the correct answer. Okay. So funding liquidity risk is defined as inability to obtain funds to meet the cash flow obligations. Okay. Liquidity risk in banks manifests in different dimensions. Which are these? What do you mean by this? Manifest means comes. It comes in various ways. Okay. It comes in various ways. Dimensions means ways. Let's keep words simple, isn't it? So liquidity risk in bank comes in different ways. What are these? Funding risk arises from the need to replace net outflow withdrawal and non-renewal of deposits. It can be. Just answer. Think over it and answer. Fine. Here, CAIIB is not like JIB. Just you got the answer, tick it. No. Here you have to think. Funding risk arises from the need to replace net outflows. Non-renewal of deposits means whatever is going out, that needs to be replaced. Suppose if tomorrow there is a huge withdrawal from your bank, run on the bank, we call it run on the bank, right? Anyone knows run on the bank? What is run on the bank? Type in the comment section. Okay, just type, do you know run on the bank concept? Type yes or no, only that much type it. Yes or no, yes or no, only that much. Don't give me run on the bank definition, it's a big definition. Yeah. Yes, no, no. Yeah, some no's I am seeing. See here, run on the bank means when all the customers of your bank, remember whatever I am saying, when all the customers of the bank come for withdrawal of deposits, all of them. So that is known as run on the bank. There's some negative news in the newspaper, something wrong about your bank. So everyone comes for withdrawal. That is run on the bank. So coming back to the question, withdrawal. Outflows, withdrawal. So we need to replace these withdrawals through fresh funds. So liquidity risk may arise from this also. Number 2, time risk arises from the need to compensate for non-receipt of funds, NPAs. Means basically, suppose if I've given a loan, so what is my logic? The logic says that that person will pay me the EMI, and or CC if given that person will pay me the interest, and that interest I'll use it for paying to the depositors. But if I don't get that interest, don't get that EMI, then what? So that will also create a time risk. Time risk means what? At the time, I'm not having the funds. Call risk arises due to crystallization of contingent liabilities. So call risk arises from crystallization of contingent liabilities. Contingent means what? Contingent means which was not to come, or future transactions, future, like bank guarantee, LC. Okay, these are all contingent. So it comes in which of these cases? Both A and B. Okay, I'll mark it like this: A, B, and C. That is the best answer. So the answer is actually this: A, B, and C. Because funding risk is to replace the net outflows. That is also correct. Time risk is for compensating the non-receipt of fund. That is also correct. And call risk is also a type of this liquidity risk only. Because if tomorrow there is a huge bank guarantee to be paid by you, then from where will you get the funds? Urgent funds. Okay. So both, both, actually it's A, B, and C. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting latest updates from IIBF on JIB and CIB. Means what is updates? from IIBF? IIBF gives various notifications. Like now it's exam time. So it will give certain notification that this exam time changed, that exam time changed, this subject's portion is this, something has been added over here, something like this they'll give. So these notifications are explained on this channel immediately. Officers Adda 24/7. Also you get free YouTube series. Here right now what are you watching? You're watching the same free YouTube series. So you get a free YouTube series on the channel for all the subjects of JIB and CIB, all. Okay. So that's why subscribe to it, click on the bell icon, click on the like button, share it with your friends. Okay. When an asset maturing in where an asset is maturing in 2 years, the liability risk will be, suppose if any asset means loan is maturing in 2 years. Okay, 2 years means what? I have given a loan and that guy or girl will be paying me after 2 years. Okay, so what is the liability risk? Now look at this liability risk. Means what risk will I face from the depositor's angle? Basis risk, yield curve risk, gap risk, embedded option risk. From the depositor side, I'll face this risk, depositors, embedded option, right? See here, if this asset is maturing in 2 years, means there is a loan. Let's look at it this way, loan. Okay. If this loan is maturing in 2 years, this deposit, I may face a deposit. Here, I have to fund this loan by this 2 years. So what I have to fund is, I have to see to it that I have sufficient deposits for this loan. But if these deposits get matured, FD gets matured, there is a withdrawal, then will I get the same FD of the same amount afterwards, if after the withdrawal? Will I get the FD of the same amount at the same rate? That is known as embedded option risk. Embedded means what? Anytime it can withdraw. Suppose if I need this 1 lakh rupees over here and this 1 lakh is withdrawn from here, depositor's angle, then my balance sheet is in a problem. So embedded option risk means there is a chance of withdrawal of FDs, withdrawal of savings deposits, plus there is a chance of repayment of these loans also. Now this is from the loan side. Somebody repays these loans. So embedded option risk is for both the sides, loan also and deposit also. Here we are talking of liability, deposit side. So that's why it's the main embedded option risk. The risk of adverse variance of mark-to-market of change in the market price of the interest rate instruments, equities, is called. So mark-to-market, what is mark-to-market? Mark-to-market means that basically the logic behind mark-to-market is, suppose if I brought let's say a bond, and that bond I am not going to sell immediately. But mark to market means what? Whether if what is notionally I am gaining some profit or not in that. That's the meaning of mark to market. Suppose if let's say you have brought a flat, you have purchased a flat, okay, for staying flat you have purchased. Now this flat you won't be selling it now because you are staying in that. But you get the daily rates for this. There are certain brokers who come to you, sir, the flat right now you had brought it at let's say 30 lakhs. Now the flat is giving you around 50 lakhs. So this is what this difference is known as notional or mark to market. Notional or other name is mark to market, M to M. Okay, M to M means what is the rate at which I had brought and what is the present value of my security. Okay. So risk of adverse variance of mark to market value of change in market price in the interest rate instruments. Interest rate instruments is called as price risk, market risk, translation risk, both A and B. What is the answer? Let me get it from you now. I'll explain you, not an issue. But let me get it from you first. It is both A and B. Price risk and market risk, both. Because here market price risk is actually a part of market risk, and price risk arises because of the interest rates. If the interest rates go up, interest goes up, interest rate goes up, then the price of the bond will go down. Price will always go down. Price. Okay. So this is basically the logic behind this. Which of the following is not a market risk? Not. Okay, not a market risk. compliance, transaction, legal, all of the above. Let me think. Type fast in the comment section. Which of the following is not a market risk? Not. Market risk means what? What is a market risk? Market risk means that risk which is not in your hands. Not in your hands. Okay, keep it very simple language. Okay, not in your hands. Russia-Ukraine war, not in your hands. Then the COVID situation, not in your hands. Right? RBI changing the repo rates, not in your hands. So this is all market risk. So which of the following is not a market risk? So compliance risk. Compliance means what? Submitting the returns or submitting the consent documents to RBI. It's in your hands. You have to follow the compliance. So it is not in your hand, right? Not a market risk. So it is, I'll write it not a market risk. N. Transaction risk. Transaction means whatever transaction I'm doing, I must maintain precautions in that. So there's no market risk. External forces are not acting on this. Legal, again, it's a part of this transaction risk only, right? Means basically operations risk. These are all operations related risks. So this is not a market risk. Answer is all of the above. Okay. Everyone download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests. Whatever we require for clearing JIB and CIB, we get it over here. So that's why download it right now, immediately, and start studying. Don't just download it and keep it. You have many apps in your mobile. Okay, just tell me, everyone, how many total number of apps you have in your mobile? How many? If you don't even know the numbers, even I don't know. How many of these apps have you watched? Do you watch regularly? I know you watch only WhatsApp regularly, only WhatsApp, tick, 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 and some other one or two more. Nothing else. Okay? Somebody might be watching that shopping apps, Amazon and all those things. That's okay. But remaining apps, we just download it and keep it. Don't just download it, use it. Go through it. What are you getting? You're getting many free features over here. Of course, paid classes are there, but free features also, free tests you are getting, free books you are getting, free classes you are getting. So download it and start studying. Okay. Country risk is an example of market, credit, operations, and liquidity risk. So country risk is an example of what? It is a part of credit risk. See here, credit risk always is of two types. Always remember this, two types. Okay. One is country and second is counterparty. I'll just write it. Okay, full only I'll write it. Counterparty. Because many of the students might not understand this. Short form of this is actually CP. Okay. But counterparty risk. So country risk and counterparty risk. Credit risk always has two parts. Okay. All of the following are types of price risk except, now again we want except means not, which is not the type of price risk. So all of the following are the types of price risk except commodity price, exchange rate, stock price, counterparty risk. Just now I gave you. What is the answer? Just now, yeah. Type fast. Just now I gave you, yeah. This one, look at this. Credit risk has two parts, credit and counterparty, country and counterparty. So counterparty will be a part of what? Will it be a part of price risk? No, it is a part of credit risk. So this is credit risk. This is not the one. This is yes, this is yes, this is yes. All these are price risks. But this is a part of credit risk. Okay. In financial market, bond prices and yields are JIB studies. Okay. Bond prices and yields are inversely related, directly related, inversely or directly depending on the type of the bond, and none of these. JIB. Okay. Give me the answer. Yes, it is. What? What is the answer? Bond prices and yields. Inversely, right? If the yields go up, what is yield? Yield means asking rate. If the asking rate of any bond goes up, the price of that bond will go down. Everyone, just now I told you that join our Officers Adda 24/7 YouTube channel. But how to join it? Sure, we are having 3 important channels. One is on Telegram, second is on YouTube, and third one is on Instagram also. Scan this QR code. For this blue one for this Telegram, this black one for this YouTube, and this one for this Instagram. Immediately pause the video, scan this. Now, why should you join here? We gave whatever is available. What is available on these channels? Free tests, free ebooks, free classes. Okay. Then paid classes are also available on the app. So scan it and join. Whatever is free, grab it fast. Okay. Welcome to Adda 24/7. We are in the BFM Sankalpa series for important theory and objective questions. Okay. And we are covering important definitions today. Of which chapter? Risk regulations in banking business. So those who are in the paid class, okay, it is useful for them also, and those who are watching on YouTube, for you also it's very useful. And kindly note, remember, join the paid classes ASAP, because here I'm taking the important definitions over here, but in the classes we have a lot of time. Okay, I'll be taking various numericals, various other theory parts also. So that's why join the paid classes, everyone. The numbers are given over here at the bottom. You are seeing this number, right? So call on that number and join it. Chalo, move on. So those who are in the paid class, kindly note, these are the important definitions which you should follow from module B. Okay, uncertainty. What is uncertainty? Under high uncertainty, banks tend to reduce loan growth, suffer more credit risk, and charge higher loan interest. What do you mean by this? Uncertainty means, like in COVID situation, there was a huge uncertainty, right? Because banks were very afraid whether the loans given will be repaid back or not. So that was the uncertain situation. So under such situations, what happens? Banks tend to reduce their loan growth. They tend to reduce their loans, right? Suffer more credit risk, because there is a huge credit risk, because there were huge NPAs during that COVID situation, and charge higher loan interest. So banks were charging higher, that is called as risk premium. Higher loan interest is called as risk premium. Okay, premium. So this is an important term under uncertainty. What happens to the banks during uncertainty period? Reduce the loan growth, everyone. Second, suffer more credit risk, higher credit risk, and higher rate of interest. Got it? Next is adverse selection. Now, what is adverse selection in this finance term? Is the difficulty to select and distinguish healthy companies with high credit rating from those that are riskier. Isn't it very important? And see here, the logic is simple, but if we don't understand it, then it becomes difficult, isn't it? So adverse selection is basically difficulty to select and distinguish healthy companies with high credit rating from those which are riskier. How will you select these? This you get it from the rating agencies nowadays. See here, you can solve this problem using the rating agencies. Like we have CIBIL over there, then we have CRISIL over there. All these companies give the ratings to various companies. Okay, these private rating companies give the ratings to these private players like Reliance or Tata or anyone. These are the big players, but there are also smaller companies. Ratings can be given to them also. So what is that? Difficulty to select a healthy company from the riskier company. It's that simple. Okay, so that's known as adverse selection. What is financial risk? Everyone, financial. Okay, you might be knowing this. Everyone knows the terms financial risk, but exactly what is required in the exam, that is the point of discussion, right? Otherwise, everyone knows what is financial risk, right? At a personal level, we always take the financial risk for investment in shares, for investment in mutual funds, right? But at a company level, at a CAIIB level, it is, what is it? See, financial risk is the possibility of losing the money on an investment or business venture. Simple and plain equation, right? Plain definition. Losing the money. Whenever I am losing the money, it's basically the risk. Some more common and distinct financial risks include credit risk, liquidity risk, and operational risk. So these are the common and distinct financial risks. So common risk means what here? I always face the problem of credit risk. What is this credit risk? Credit risk means if the bank gives a loan to somebody, whether the loan will be repaid or not. That is known as credit risk. Whether it will be repaid or not. Okay. Liquidity means what? If I give too many loans, suppose if the bank gives a higher percentage of loan as compared to its deposits, then it will be facing a difficulty in paying the normal rate of interest also. Okay. Or normal liquidity risk it will face for paying the common bills. So liquidity means whenever you give the loan, you should always see to it that the loan percentage it has a maximum limit up to for the deposit purposes, deposit percentages. If I have given a deposit of rupees, if I am having a deposit of rupees 100, I must give the loan up to 70 rupees only. 70% is a good ratio for loans. Okay. So liquidity risk. And next one is operational risk. Operational means what? Operational risk relates to my operations. Means my employee errors or my system failure or my region failure, area failure. Area means what? There is a terrorist attack, there is a flood. So all these lead to operational risks. So financial risk also has these parts: credit, liquidity, and operational risk. Clear? Simple? Risk adjusted return. Now tell me, what is risk adjusted return? Firstly, tell me risk adjusted means what? Okay, I'll ask you a question over here. Suppose if you are investing in FD of a nationalized bank or in a mutual fund, you are investing in a FD or in a mutual fund. Which of the investments will carry higher risk over here? Will the FD of the bank carry higher risk or will the mutual fund carry the higher risk? What do you say? Type fast in the comment section. Which one of the which one of the investment will carry higher risk? Investment in FD of the bank or investment in mutual fund? Obviously, isn't it? Mutual fund. So that's why the returns from those mutual funds are always called as risk adjusted returns. The risk adjusted returns measures the profits on the investment your investment has made relative to the amount of the risk the investment has represented throughout the given period of time. So what is the risk involved in this investment? Amount of risk, okay, relative to the amount of risk. That is important. Now, if I invest in bank FD, then the risk is zero. Nationalized bank FD, then the risk is zero. Okay. But if I invest in mutual fund, there is the risk involved in it. So this risk factor, I'll have to consider using my other derivative products. So this risk is to be mitigated using the derivative products. So those derivative products will require higher cost. See here, if you are buying I'll give you a simple example over here. Okay. Suppose if you are buying Reliance right now, Reliance share. Okay. You are buying a Reliance share at, let's say, 2500, expecting it to go up. Okay. But if it goes down, then to cover this downside potential or downside risk, what do you do? This risk is covered using put options. But this put options, whenever you buy this put option will carry the cost, because put option doesn't come for free. So this will carry the cost. So this is known as the risk, amount of risk, and it is known as the risk capital. Risk capital. How much risk capital I keep for my risk to cover my risk. Okay. So this is to cover the downside. I'll buy a put, and this put will cost me something, and this will be known as my risk capital, which I keep it aside. Okay. Everyone subscribe to Officers Adda 24/7 YouTube channel. In this channel, you will be getting the latest updates on JIB and CAIIB from IIBF. Means IIBF gives various notifications regarding dates, times, change in the subjects. So All these are immediately given on the Officers Adda 24/7. Also, you get free YouTube series, right? Free YouTube series. Right now, what are you watching right now? Free YT series. So same free YT series, you get it for all the subjects. Okay, so subscribe to it, click on the bell icon right now. Okay. Risk adjusted return on capital, RAROC. What is RAROC? Have you heard this term RAROC? Type yes in the comment section. Have you heard this term before? RAROC. Type yes in the comment section or no. Whatever. Yes or no. So it is. Yes, I've seen many of them. Yes. Okay. So risk adjusted. We have heard the term, but we don't know the exact meaning of this. Risk adjusted return on capital means what? It is a risk adjusted measure of return on investment. Risk adjusted measure. Okay, what do you mean by risk adjusted measure? What do you mean by risk adjusted measure? Here, it does this by accounting for any expected losses and income generated from the capital, with the assumption that the riskier project should be accompanied by higher expected returns. So risk adjusted returns means what? See here, RAROC. So same as this earlier, we have seen one earlier definition just now. Similar to this, higher the risk, higher I'll be expecting the return. So higher expected returns. So if I'm investing in higher riskier projects, then I should get a higher return. Only then I'll invest in the higher riskier projects. Otherwise, won't I invest in the FD, bank FD, isn't it? So it does this by accounting any expected losses. What all losses can occur whenever I invest in some riskier project, okay, and income generated by that capital. So whatever capital I've invested, what is the income generated from that? Whether it suits my this risk adjustment. Okay. Same example. Suppose if I am investing in FD or in mutual fund. So definitely I'll expect higher returns on the mutual funds, right? Whereas in FD I'll be expecting lower returns. Risk management process means what? Managing the impact of the risk by analyzing, forecasting and making predictions based on the historical trends. It also includes taking corrective measures to reduce the impact of the risk. So what do you mean by this? See here, managing the impact of the risk by analyzing, forecasting and making predictions based on the historical trends. Analyzing, forecasting and making the predictions. Okay. So all the three steps are involved in risk management process. First is analyzing, second is forecasting, third is making the predictions based on the historical trends. Okay. It also includes corrective measures to reduce the impact of the risk. Corrective measures. What do you mean by corrective measures over here? Corrective measures over here means, suppose as I gave you the earlier example, if I am buying a Reliance share, then I must buy a put. See here, this is called as long position. Long means, suppose if I buy a Reliance share, okay, at 2500 expecting it to go up. So this is my long position. Whenever I am having a long position in stocks or commodities, then in the derivatives option or options market, I must have the reverse view. So in that market, I'll buy the put option. Put means what? If the market goes down, then the value of that put increases. Okay. So that's why whenever you are long on commodity, you must always buy put options to hedge that risk. And this is known as the hedging. Corrective measure means hedging. Okay. Maturity mismatch. It refers to the situation when company's short-term liabilities exceed its short-term assets. So short-term liabilities exceed short-term assets. What do you mean by this? We are talking of short-term only, okay? Short-term liabilities exceed the short-term assets. Means suppose if my loan, liabilities mean deposits. If my bank's deposits are much more than my assets or my loans, then I'll definitely face the problem of liquidity. Means I'll be facing the problem of this interest rate risk, because the interest going out will be higher as compared to the interest coming in, right? So maturity mismatches are visible on the company's balance sheet and can shed light on its liquidity. So immediately if there is a maturity mismatch, it will be shown in the company's balance sheet. Why? Because the interest difference will immediately be displayed. Well, after all, you can't hide anything from the balance sheet. Okay. Maturity mismatches often signify a company's inefficient use of its asset, isn't it? Company's inefficient use. It means what? If I am having the loans, then I must use it properly. Properly means what? As a bank, I must see to it they are going to the basically to the productive assets, not to the NPA ones, right? Number one. Number two, also the durations of the loans and the deposits need to be matched. Duration. Okay, that's what the maturity is says. Suppose if I am having a loan, or if I take a deposit of, let's say, deposit, okay, if I take a deposit of, let's say, 1 year, of, let's say, 1 lakh, okay, and I have to give a loan against this. So the loan against this will definitely not be more than 1 year. Loan should also be 1 year or less, right? So if I give a loan of 1 year, it's the best. So 1 year, it should be, the maturity should match of deposit and loans. Okay. Market value of the equity. It is the total rupee value of the company's equity and is known as the market capitalization. What do you mean by this capitalization? Understand this word. See this. It means that if Reliance share, let's take Reliance only. I take Reliance share because it's a known share to everyone, isn't it? So now, suppose if I take a Reliance share, and this Reliance share now, let's say, is priced at 2500. Okay, let's say 2500. And now what happens? This Reliance has issued, let's say, I'm giving an example, 1 lakh shares in the market. Number of shares is 1 lakh. So what is its market capitalization? So the market capitalization over here will be 2500 into 1 lakh. So 2500 into 1 lakh. So those many rupees, okay, will be the market capitalization of Reliance. Okay. So that is known as the market value of the equity or market capitalization. Total rupee value of the company's equity. This is the total rupee value of the company's equity. The measure of company's value is calculated by multiplying the current stock price by the total number of outstanding shares. See this, we have done the same thing. Current market price into total number of the outstanding shares. How many shares have been issued in the market? Okay, that is known as outstanding shares. Got it? So Reliance shares over here, the market capitalization will be, okay, give me the answer everyone. 2500 into 1 lakh. What is the answer? 1 lakh means how much will it be? Yeah, 2 crores. Then yeah, 25 crores. Yeah, it will be around 25 crores, right? 25 CR. That will be the answer roughly, right? Yeah. Coming back, chalo. Next one. Before going ahead, download Adda 24/7 app on your mobile. In this app, you will be getting the premium study material plus live classes, ebooks, tests, whatever we need for clearing JIB and CAIIB, we'll get it over here. So download it right now and start studying. Okay. Next one. Downside potential. It is the estimation of securities of a security's potential loss in the value if the market conditions precipitate a decline in the security's price. Means what? Here, potential loss, keep it very simple. Potential loss due to decline in price of the security. Means, for example, we have studied this in our ABM also, okay, or in our JIB also. If the price of the bond, let's say, let me take Reliance only, okay, Reliance share. If I brought it at 2500 and if tomorrow the price of Reliance goes down to, let's say, 2000. So what is this happening? This is the downside potential. Securities potential loss due to the decline in the securities price. Okay. Depending on the measures used, downside risk or explains a worst case scenario for an investment and indicates how much the investor stands to lose. So worst case scenario means what? What is the lowest level which this stock can go down, or what is the lowest level at which this bond can go down? Okay. So worst case scenario over here is always taken into account by any company whenever you're doing a conservative investment. Okay. indicates how much the investor stands to lose, how much this investor will lose if this downside potential, means if the Reliance share goes down. Okay. Next is CCIL. The Clearing Corporation of India was set up in April 2001 to provide the guaranteed clearing and settlement functions for the transactions in money, government securities, foreign exchange and derivative market. Remember, here it's not talking of stock market. So provide guaranteed clearing. Guaranteed means what? What do you mean by this guaranteed? Isn't anything guaranteed then? See, this guaranteed clearing over here means it is called a settlement risk that is cleared. Okay. Guaranteed over here means settlement risk is nullified over here. What is settlement risk? Settlement risk means, let me give you an example. If you sell, let's say, shares, okay, you sell, let's say, shares to anyone, shares, okay. So this other person, Mr. X should give you rupees, right? Rupees, because you are giving the shares, Mr. X will give the rupees. So what do you mean by settlement risk? If you give the shares and Mr. X does not give you rupees, then what? Then this is known as settlement risk. So CCIL guarantees this part. Provides a guaranteed clearing and settlement function for transactions in money, government securities, Forex and derivative market, right? So CCIL is, okay, tell me one more thing. This shares example which I gave you, does CCIL take care of the shares over here? Does CCIL take care of the risk of the shares, settlement risk of the shares? No. Then who takes care of the settlement risk of the shares which you buy and sell? Type fast in the comment section. Who takes care of the settlement risk of the shares which you buy and sell? Who takes care? Because here CCIL is very clear. CCIL is money, government securities, foreign exchange and derivatives market. 4, clear? Does it say anything about shares? No. So who talks about shares then? Correct. NSE and BSE. NSE and BSE, these stock exchanges, they take care of the settlement risk of the shares. And for others, everything else, there is CCI. Okay? Yeah. Like that, there are some things which money can't buy. For everything else, there is MasterCard. That was the ad. Remember anyone? Now gone, isn't it? MasterCard was having an ad few years back, that there are some things which money can buy, and for everything else there is MasterCard. Similarly over here, only share settlement risk is taken by NSE and BSE. For everything else there is CCI. Okay. What is EWRM or EWRA? What do you mean by this? Enterprise-wide risk measurement or risk assessment. Enterprise-wise means what? Enterprise-wide means total related to enterprise. Complete company-wise. EWRA or M you can call it, assesses the risk of anti-money laundering, counter-terrorist financing, means AML and CTF, and sanctions, in addition to the counter-proliferation financing and anti-bribery and corruption. Now these are important terms which may come to you in exam. Okay. So money laundering, AML, counter-terrorist financing, okay, means terrorist financing. Okay. Then second is counter-proliferation financing. Okay. This is again a type of this AML only. Anti-bribery and corruption. Anti-bribery and corruption. So bribery related and corruption related. So this, even bribery and corruption is part of this enterprise-wise risk, because after all it's a risk, isn't it? Thus these are most inclusive elements of EWRA. So these are all the inclusive elements of EWRA or EWRM, right? Remember, whenever you are talking of enterprise-wide risk measurement, it means you are talking of the whole company, not of a specific section. Okay. Now, before everyone, I would suggest, kindly, I told you just now, join the Adda 24/7 Officers Adda 24/7 channel. How to join it? Suppose if you have to join on this Telegram, okay, scan this blue QR code. Pause this video and scan this blue QR code. If you have to join this YouTube channel, scan this right side QR code, this one. Okay, this one. If you have to join the Instagram channel, so scan this blue QR code, this one. Okay, and you can join this. Here there are many benefits available for this. Okay, so definitely I would suggest join. Everyone should join this because this is very useful to you. Remember, we give various questions, various recordings plus tests are available on these channels for free also. It's not only paid, many of them are free also. Okay,